It's time for the ADP report. The survey showing private employers added 324,000 jobs last month. That is well above what the street had been anticipating. Estimates were only for 175,000 jobs. ADP says that job creation remained robust in July, with leisure and hospitality once again driving growth. In fact, that's what we heard earlier this week from the other survey that we watched so closely on jobs, too, leisure and hospitality really being the big deal. ADP says manufacturing, though, was a weak spot. It's an interest rate sensitive industry that lost jobs for the fifth straight month. June's monster gain of 497,000 jobs was revised down to 455,000 jobs. Notably, pay growth saw a continued downward trend in July. Job stayers saw a year-over-year pay increase of 6.2%. That is the slowest pace of gain since November of 2021. Of course, this is a few days before we get the big jobs report that comes out. We always look to ADP as potentially being a signal of that. ADP looks at a very broad swath of the U.S. private sector. Again, that number coming in much stronger than had been anticipated. You're talking about a gain of 324,000 jobs versus the 175 estimate.
Let's continue to talk about this for more on the ADP report and the nation's jobs picture ahead of the Friday's big report. I want to bring in ADP Research Institute's chief economist, Neela Richardson. Good morning to you. Of course, everybody looks at these numbers and says, you know, how correlated are these numbers going to be to be what we see on Friday?
Hi, good morning. Look, this is an independent look at the private sector. ADP provides payroll services for over 25 million workers. That's 1 in 6 in the United States. And so we feel that we have the data and we have to really share with the world, the public, what's going on in the labor market from the private sector. Now, we think that over time, you'll see the numbers today and the numbers on Friday trend in the same direction. But there's no reason to expect that they are in lockstep because they're based on very different underlying data. What I will say as well is that better than expected should be the phrase of the summer because it's certainly true in the labor market. This is a market where 2/3 of the hiring was done by small businesses with less than 50 employees. So really strong in that segment.
So, look, the other big question is going to be, how does the Federal Reserve see these numbers? What do they say? How strong is the economy? Is the economy too strong?
Yeah, well, I'm of the firm belief that the economy can never be too strong as long as prices are stable. And that's the job of the Fed right now. What we're seeing is an incredibly strong market, but is also an incredibly fragmented jobs market. The picture is not lockstep. You see softness in the goods sector that reflects the underlying survey data in manufacturing. You see softness in interest rate sensitive sectors like finance, for example. You see softness in large companies. They actually pulled back their hiring in July. So this is a strong but highly fragmented labor market. But for the Fed, the key data point is the wages, the pay gains, which has come down. We're seeing 6.2 million in the survey we match. When we look at new hires, we continue to see pay growth for those employees first in the door going down, and sometimes there's outright declines. In some ways, that's good for the Fed's inflation battle, but at 6.2%, we're still double the percentage growth that we used to see before the pandemic. So there is a suggestion here that wages have come down, but maybe not as much as the Fed would feel comfortable with.